You know how every investor says, I'm a long-term investor, but at the first sign of a little volatility, they panic and sell? Well, I don't want that to be you. And a deep understanding of this one concept will help you avoid that altogether. Hi, I'm Nahum Lobo. Welcome to Clover Capital. Today, we'll be talking about market cycles. What are they? What are the factors that influence them? And how can you practically apply this one concept to level up your investing journey?
So let's jump in and try to first understand why does the economy and equity market grow over time. At the core of it all is an increase in productivity and output. As businesses, governments, and society get more efficient and innovate more, it leads to productivity growth and increases in the overall output, which in turn leads to growth in incomes and earnings. First, let's visually try to grasp what a market cycle looks like. Now let me take you back to school and let's look at a graph where on the x-axis at the bottom we've plotted the passage of time, and on the y-axis on the left we have the growth in GDP and equity index prices. I'm sure you've heard that India's economy grows at on average about 6% a year, and that is what the black line depicts. However, in actuality, this growth is a lot more like what the blue line shows. Growth is lumpy and occurs in phases. This is what we call a business cycle. Now, as you can see, I have marked out the different phases of the business cycle. Starting with an expansionary phase, this is when the economy is on a strong growth trajectory and growth is robust. Then we have a peak where growth starts to plateau, and this kind of marks the end of the economic boom cycle. And as growth slows down, we transition into the next phase, which is the contractionary phase. During a contraction, the economy slows down, all the economic metrics start to dwindle until we reach a stage where things stabilize at the bottom, which we call the trough. This marks the end of the bust cycle and the beginning of the next expansionary phase and boom cycle. So this is broadly a basic understanding for you of what a business cycle is. Now let's focus and try to understand what a market cycle is. To put it very simply, a market cycle is a pattern that you can observe in the movement of equity prices. Equity prices, in theory, should reflect the performance of the underlying businesses which they represent. Those underlying businesses are closely influenced by the business cycle. And this is what makes the market cycle and the business cycle look very similar. However, there are two key areas where their behavior diverges. The first is, as you can see, the market cycle leads the business cycle by about 6 to 12 months. This is because the markets are forward-looking and they factor in possible changes in the business cycle before they actually happen. The second area where market cycles and business cycles differ is that market cycles reflect the movement of equity prices, and so they are significantly more effective by changes in investor sentiment and liquidity conditions. This causes market cycles to be a lot more volatile, and this causes them to sometimes diverge from the actual happenings of the underlying business cycle. We can illustrate this by looking at an event where investor sentiment changes rapidly due to a geopolitical occurrence, while in actuality, the effects of the geopolitical occurrence may not be as severe or as abrupt as the price correction might indicate. So now, as we move on, let's technically look at how long a market cycle lasts. The technical way of measuring a market cycle is the distance between two all-time highs or cycle tops. Let's look at the NIFTY 500 chart to better understand this. In the NIFTY 500 chart before you, we have plotted the all-time highs before a correction in dark yellow. And what you will notice here is that there is no exact time period that a market cycle could last for. So a more practical way to interpret this from a portfolio strategy point of view is to assume a cycle could range from anywhere between 3 to 5 years. So Now that we've understood what a market cycle is and how long it lasts, let's try to understand what are the factors that influence it. The economy is a dynamic system and there are many factors that move the markets. Key among them is monetary and fiscal policy. Central banks like the RBI and Federal Reserve take actions like increasing and decreasing interest rates. These changes in turn influence borrowing costs and liquidity within the system. And that affects spending and investment within the economy, changing the market cycle. Changes in fiscal policy, on the other hand, like tax cuts or hikes, government capital expenditure announcements, incentive policies, etc., all similarly help shape and boost the market cycle. Economic conditions like changes in GDP growth, corporate profits, employment rates, inflation, and consumer demand also impact the market cycle. Economic expansions tend to fuel market growth, while contractions contribute towards downturns. Another key factor that drives market cycles is investor sentiment. Investors' emotions like fear and greed play a massive role in driving movements within the market cycle. Investors' optimism during bull phases and pessimism during bear phases creates cyclical buying and selling opportunities. Legendary investor Howard Marks believes that it is this investor sentiment that leads to markets overshooting on the upside and downside. Technological innovation like advancements in AI, robotics, etc., all boost productivity and overall output within the economy and is a great catalyst for boosting market cycles. Geopolitical conditions like pandemics, wars, political instability within the country, commodity price shocks, these all trigger huge changes in the market cycle during phases. And lastly, supply and demand dynamics is one of the core drivers of market cycles. Prices of an asset in a financial market are driven by demand and supply flows. When demand for assets is more than the supply, the price starts to increase, triggering the start of a boom phase. Similarly, when supply of an asset exceeds the demand for that asset, it results in the price declining, marking the beginning of a bust phase. Alright, so let's tie everything together now by looking at the 4 stages of a market cycle. Let's begin with the first stage, the accumulation phase. Every market cycle begins with an accumulation phase. This is when domestic institutional investors, aka DIIs, and foreign institutional investors, aka FIIs, also termed as smart money, start buying shares quietly and at low prices. This is usually after the market has bottomed. At this phase, prices tend to move sideways and in a range with relative moderate volatility. This phase is marked by consolidation and sets the foundation for the next phase, which is the markup phase. This is what one would typically term as the bull market. Prices break out of an accumulation range and begin their trajectory upwards. This phase is characterized by growing investor confidence and increased buying activity. It often attracts a lot of retail investor participation. It's typically the most profitable phase for investors since prices rise the most during this phase. The third phase of the market cycle is the distribution phase. In this phase, early buyers and institutional investors start selling their shares to lock in their profits. Prices tend to move sideways again, but with more volatility. Investor sentiment starts to get mixed and in some cases turn negative, signaling the potential top of the market. The last stage of the market cycle is the markdown phase. This is what one would call as a bear market or negative phase. It is characterized by falling prices. Selling pressure dominates as investor sentiment turns negative or even fearful. The markdown phase continues until prices reach a new bottom and the cycle starts again with the accumulation phase.
Alright, so now that we've learned what a market cycle is, how long it lasts, what are the factors that affect it, and the different phases of the market cycle, let's try something fun. Let's go back to 2020 and apply what we've learned to
to see how the Nifty 500 story has played out through the lens of a market cycle. So before we start, just a brief explainer on what the Nifty 500 index is. It's an index comprising the 500 largest companies in India and represents about 95% of the Indian equity market. So the story begins with the markdown phase that began in early 2020, which was caused by, of course, the COVID-19 pandemic. As a consequence of this, the government announced mass lockdowns, which caused the economy to slow down, and layoffs. In the financial markets, sentiments flipped negative as investors panicked and began frantically selling their equity holdings. This imbalance of a large number of sellers and few buyers for Indian equities pushed prices and valuations lower, leading to a relatively sharp markdown phase. As we fast forward a few months, we enter an accumulation phase. As the government of India announces a stimulus package with a liquidity injection and interest rate cuts, this stimulus helps stabilize the economy. Investor panic starts to subside as people adapt to the new normal and restrictions around the lockdown ease. During this time, institutional investors become early buyers and help bring stability back to the financial markets. Eventually, as the economic stimulus makes its way through the economy, it causes a rebound. Spending increases and corporate profits improve significantly. This, paired with an increase in retail investor participation, fueled the mass adoption of discount broking apps, results in equity prices rising significantly, as seen in the prolonged markup phase, which lasted for about a year. As we enter the latter half of 2021, valuations were quite stretched and selling pressure returned as institutional investors started booking profits. This caused the market to form a top and enter a distribution phase. This phase is marked by inflation starting to inflect due to prior government stimulus activities, and concerns about tightening in monetary policy start to turn investor sentiment negative. That eventually culminates in a markdown phase, triggered by interest rate hikes by reserve banks both domestically and internationally. Investor sentiment further deteriorates as geopolitical tensions and commodity prices rise. Prolonged high inflation expectations set in, and this sets the tone for a period of tight monetary and economic conditions. Now, as we enter 2023, with interest rates high and a steep correction in equity prices, equity markets enter another accumulation phase. Valuations start rationalizing, investor sentiment starts to rebound as there's a gradual improvement in economic metrics like inflation reducing and economic output increasing due to government spending. Little green shoots start emerging in financial markets as corporate profits start to rebound and grow. A pause in the interest rate hiking cycle both domestically and internationally triggers the start of a new markup phase in mid-2023. Strong corporate earnings growth and further improving economic conditions flip sentiments positive. Equity markets rise steadily, supported by strong retail participation again, but this time fueled through mutual fund flows. Going into the latter half of 2024, we see a slowdown in credit growth due to high interest rates and a deterioration in credit quality in certain pockets like microfinance and unsecured lending. All this, paired with valuations starting to get frothy and a declining rupee, causes the party to come to an end, as foreign institutional investors start aggressively selling down their positions, forcing the markets into a distribution phase. Subsequently, a slowdown in government spending due to elections, paired with a reduction in urban consumption, causes corporate profits to decline, leading to another markdown phase in Indian equity markets. Which brings us to today, where on the one hand we have headwinds caused by the escalation in conflicts in the Middle East and Europe, as well as tariff uncertainty between US and India. On the other hand, we have the government and Reserve Bank taking strong actions to boost credit growth and consumption in the economy through interest rate cuts, as well as the rationalization of GST and income tax rebates. In financial markets, valuations have started to moderate, and a rebound in demand in rural and urban consumption could be very good for corporate earnings and market sentiment overall, which indicates that at this point we are most likely in an accumulation phase. Looking to the future, however, some catalysts that could trigger the next phase of markup are festive season spending, further interest rate cuts, government spending ramping up, Indo-US tariff agreement settlements, and possible new free trade agreements with other countries. All these events could trigger a strong inflection in corporate profits. Earnings upgrades could then further result in FII flows returning, especially since we've been through a decent period of time and price correction. So that's a rough breakdown of what the market cycle has looked like over the past few years and where we are now. Let's wrap things up with a quick conclusion of what we've learned and some key points to keep in mind. Number 1. A true long-term investor is someone who has a holding period of at minimum 5 years. As you can see, with a holding period that long, you will eventually weather an entire market cycle and come out on top. Number 2. You do not want to fall prey to your emotions during the mark-up phase and the markdown phase of the market cycle. Tracking information like interest rates, market PEs, corporate earnings, changes in government policy will ensure you have a complete picture and are objective in the actions you are taking. Number 3, plan your asset allocation depending on where you are in the market cycle. This goes a long way in generating alpha in your portfolio and ensuring you have a smoother journey. Well, that brings us to the end of this video. If you found this video valuable, do share it with your friends and family. And if you have any questions or topics you would like us to cover in the future, you can drop them down in the comment section below. Thank you for watching and see you in the next one. Cheers.